Welcome to the Deep Dive.
Hey there.
Today, we're jumping right into a pretty interesting call from the Motley Fool.
Oh, yeah. What's that?
They're making a case for buying Amazon, AMZN.
Okay, Amazon. Not exactly a small company.
No, exactly. And what makes it stand out, really, is that this recommendation comes after it dropped, what, like 20%?
Right, so not when it's hitting all-time highs. That's the hook.
Exactly. So our mission today is, well, to figure out why they're flagging this particular growth stock right now with all this economic uncertainty swirling around.
Yeah, it makes sense. I mean, the market has felt pretty choppy lately.
Definitely.
And sometimes those are the moments, where opportunities pop up if you look closely. So the refool is highlighting Amazon, suggesting it might be a smart play for, well, long-term investors.
Okay.
But to really get why, I think we first need to set the scene, what's been going on in the wider market.
Good point. Let's unpack that. The article does mention growth stocks generally having a tough time. Why is that?
Well, the Fool points to how expectations have been shifting.
Shifting how?
Earlier this year, there was this kind of optimism. Things may be improving, interest rates might come down.
Oh, right. I remember that feeling.
But then President Trump's talk about new import tariffs kind of threw a wrench in the works.
Okay. Tariffs, that always stirs things up.
Yeah, it injects a whole lot of uncertainty. The main worry is, tariffs mean higher prices for goods.
Which isn't just about us paying more at the checkout, right? It hits businesses, too.
Absolutely. That's the big concern. If costs go up for companies, it can squeeze their profits.
Yeah.
Makes it harder to grow.
And that could slow down the whole economy.
That's the fear. The article even brings up Fed Chair Jerome Powell. He apparently noted that these duties could actually push inflation up.
Oh, wow. So the opposite of what the Fed wants.
Exactly. Moving away from their economic goals.
So, okay, with all that uncertainty, tariffs, inflation worries, investors maybe get a bit nervous, especially about growth stocks.
Precisely. Growth stocks are often seen as more sensitive, If the economy looks shaky, their growth might slow down too. So some investors started selling.
Okay, selling creates the dip.
Right.
But this is where the fool sees the opportunity, I guess.
That's their angle. They argue this sell-off has pushed some solid companies down to bargain levels, at least for folks looking long-term.
And Amazon is their prime example here. The e-commerce giant, but also cloud computing, right? AWS.
Exactly. Two huge areas. And if you look at Amazon's history, the article highlights this.
What's the track record look like?
Generally, it's been an upward trend, both for earnings and this metric called return on invested capital, ROIC.
ROIC. Remind us what that shows.
Think of it like, how well is Amazon using its money to make more money? A rising ROIC is usually a good sign. Shows efficiency, profitable growth.
Okay. So mostly up, but you said generally. Was there a hiccup?
There was. The article points to that recent high inflation period. Amazon actually posted an annual loss in 2022.
A loss. Yeah, that would definitely catch your eye. Might worry some investors.
It could, on the surface. But the crucial part, according to the article, is how Amazon reacted.
What did they do?
They didn't just, wait it out. They apparently did a major overhaul of their costs, their whole structure.
Streamlining things.
Yeah, a deliberate move, not just to bounce back fast, but also to set themselves up better for the future, whatever the market's doing.
And did it work? The article says they got back to profit the next year.
It seems so. Back to profitability, and then quarterly earnings growth picked up again.
That's a pretty quick turnaround.
It is. And importantly, that ROIC metric, the article says it's climbing again.
Ah, so suggesting those investments and cost cuts are paying off, generating better returns now.
That seems to be the indication, yeah, that the adjustments are working.
Okay, so the financial picture is improving after that rough patch. What about the core businesses? E-commerce is still massive, obviously.
Oh, absolutely. Huge selection, right? Everything from basics to, well, almost anything else you can think of. Big advantage there.
Okay, but let's circle back to those tariffs. That's got to be a concern, right? Especially since Amazon imports a lot from China.
It's definitely a potential headwind, the article acknowledges. It raises questions.
Like what? Higher prices for us.
That's one possibility. If tariffs raise Amazon's costs on goods they import, they have a choice. Absorb it, which hits their margins.
Or pass it on to consumers.
Exactly. Higher prices.
And it's not just Amazon's own stuff, is it? What about all those third-party sellers on their site? Many are based in China, right?
That's another layer, a really important one. If tariffs make it too expensive or complicated for those Chinese sellers...
They might leave the platform?
Some might. And since Amazon gets fees from those sellers, listing fees, commission, losing sellers could potentially ding their revenue streams a bit.
Hmm. Okay, so potential cost increases, potential hit to third-party seller revenue doesn't sound great.
It presents challenges. But interestingly, the article also suggests a potential sort of silver lining for Amazon from these same tariffs.
Really? How so?
It's about the competition. Think about those ultra-low-cost Chinese e-commerce sites like Shein or Temu.
Ah, yeah. They've grown fast.
Very fast.
Yeah.
Their whole model is based on super low prices, often shipping direct from China. If tariffs hit them hard, making their stuff significantly more expensive.
Then maybe shoppers look elsewhere, like back to Amazon.
That's the idea presented. Consumers might see prices rise sharply on Shein, for example, and decide Amazon is a better alternative, even if Amazon's prices have nudged it up a bit too.
Huh. So tariffs could hurt Amazon's imports, but also hurt their low-cost competitors more, potentially shifting sales back to Amazon.
There's a possibility. Sort of levels the playing field a bit, maybe. Makes those ultra-cheap options less compelling if the price gap shrinks.
Interesting dynamic. It's complicated.
Definitely complex. Lots of moving parts.
But the article also stresses, look, Amazon isn't just the online store. There's AWS.
Exactly. Amazon Web Services, their cloud computing arm. That's a huge part of their overall profit picture, often the main driver.
So how do tariffs play into AWS?
Well, there could be some impact. Maybe higher costs for some hardware components they need for their data centers if those components face tariffs.
Okay, so maybe some cost pressure there too.
Potentially.
Yeah.
But on the flip side, the market for artificial intelligence, it's absolutely booming.
Right. AI needs massive computing power.
And AWS provides a lot of that power. So the demand for AWS services, driven by AI, is seen as a really significant revenue driver that could, more than outweigh potential hardware cost increases.
Okay, so even if tariffs create some headwinds for the e-commerce side and maybe slightly for AWS costs.
The sheer growth in cloud, especially fueled by AI, could be a much bigger factor for the bottom line.
So the overall picture of the full pants is resilient.
I think that's fair. They seem to suggest Amazon has shown it can navigate bumps like that inflation period.
Right, with the cost restructuring.
Yeah. And that the long-term story, powered by both e-commerce dominance and AWS growth, particularly with AI, looks strong.
Which brings us back to the price. After that 20% drop, where does it stand? The article mentioned valuation.
Yeah, it said the stock is trading around 27 times forward earnings estimates.
Forward earnings. So what analysts expect them to earn in the future?
Exactly. It's a common way to gauge if a stock price is high or low relative to expected profits.
And at 27 times, what's the verdict from the fool? Too high, too low?
Their conclusion was that it looks very reasonably priced.
Reasonably priced, okay.
Which, combined with the growth outlook and everything else, leads them to call it a great stock to buy on the dip.
Buy on the dip. Got it. Now, they did include some disclosures, right? Standard practice, but good to know.
Yeah, transparency is important. They mentioned John Mackey.
Former CEO of Whole Foods, which Amazon owns.
Right. He's on the Motley Fool's board.
Yep.
And also, the author of the article, Adria Semino, holds Amazon shares. And the Motley Fool itself, the company, also has positions and recommends Amazon.
Right, so standard disclosures just for awareness.
Exactly. It's context for the recommendation.
So let's try and wrap this up then. The key takeaway seems to be,
Yeah.
yes, there are near-term question marks, especially around tariffs.
Those are real uncertainties.
But the Motley Fool's perspective is that Amazon's core strengths are just too significant to ignore.
Pretty much. The e-commerce foundation, the huge growth engine of AWS, especially with AI adding fuel.
Plus the fact they already successfully navigated that recent inflationary pressure by fixing their costs.
Right. All that together at the current stock price makes them see it as an attractive long-term investment.
Okay. Makes sense.
It does leave you with something interesting to think about, though.
Oh, yeah. What's that?
Just how these big sort of macro things like global trade policy and tariffs,
No.
how they can create both challenges and opportunities for specific companies.
Yeah, it's not always straightforward, is it? One factor can cut both ways.
Exactly. And it really highlights how understanding a company's, fundamental business, what they actually do and how they make money, their financial health, how that helps you sort through the noise of these bigger economic shifts and maybe spot opportunities others might miss. Makes it think, doesn't it?